We will have something.
I'm sorry.
Okay. So before we discuss Centralia, I will briefly talk about the multinational or international capital budgeting, and then we will go into the example, okay?
All right.
All right. So capital budgeting, probably you learned about this maybe in a basic finance class or introductory finance class. It is a framework that allows us to make disciplined investment decisions.
Yeah.
It is a process that involves laying out the project cash flows. Usually we look at the project cash flows at 3 stages: the investment stage or initial outlay, the operational stage where the project becomes operational and starts to generate cash flows, and then there is a terminal stage where we assume that at the end of an economically useful life, project is terminated. So the cash flows involved in a capital budgeting is involves these 3 stages of cash flows. Okay.
Yeah.
The investment stage could be quite simple. That there could be one-shot investment, and then project becomes operational and project starts to generate cash flows. Under some other circumstances, like large infrastructure projects, the initial outlay could stretch over multiple years. This is always the case in large infrastructure projects, in oil exploration, and a number of cases. So that should not matter much, because even if the investment is stretched over a few years, we will figure out a time frame where we're going to evaluate those cash flows, and then we can incorporate it into the analysis. So I mean, this is a generic framework that we use whether we make these investments in a domestic context or in international context. Obviously, in an international context, there are a lot of complications. Obviously, the project risks vary, and they are much steeper in the case of international projects, because you are conducting investment or executing investment in a different political economic setting. There are exchange rate issues. That is, you are going to probably generate your cash flows in a different currency than your home currency. So we need to incorporate exchange rates into our analysis. In some cases, governments that offer either preferential tax treatment or provide concessionary loans, there are some subsidies that actually the investor can benefit from. So they need to be incorporated into the valuation process. So in the international context, things are a little bit more complicated, and risks are more complex. In that sense, it is a more involving process than the domestic context. Here, I have the layout for the generic capital budgeting process. As you see, first we identify the capital that we put at risk. That is essentially the amount of commitment that we have to the project in terms of capital, okay? Then we estimate the cash flows associated with the project. As I told you, this involves operational cash flows as well as the terminal cash flows. Another important issue in the capital budgeting process is to determine the appropriate discount rates to calculate the present value of the cash flows. And then we will find out, we will apply a decision criteria such as net present value, internal rate of return, or modified version of internal rate of return to see if the project really generates value. There are several other decision rules or decision criteria, but we are going to focus only NPV and IRR when we discuss these projects, okay?
Yeah.
So here is a simple representation of how we estimate the project cash flows during the operational stage. So as you see in here on the top, we have the project revenues. Then you need to subtract the project cost. That brings us, in some ways, the operating profit associated with the project. So EBIT, or earnings before interest and taxes, some equivalent of that. And then we apply tax on EBIT, which brings us to the net operating profit after tax. Okay? So this is the sort of a earning powers, indicator of earning powers after tax profit of the project. And then we add back depreciation because depreciation is a non-cash expense. It's already subtracted when we get to the EBIT because it is included in the project cost or operating cost of the project. So that's why we reclaim it. We add it up to figure out how much really the project is generating in terms of cash. We make adjustment for the working capital investment or working capital requirement. And also if there is any capital enhancements associated with the project, we need to subtract the capital expenditures. So that gives us what we call free cash flows to the project or free project cash flows, okay?
Yeah.
So, or we could approach it slightly differently. We could start with EBITDA, take the tax out of that. That again brings us to the net project operating cash flows after tax. Then we make the working capital adjustment and still get to the free cash flows of the project. In this case, again, there is an implicit assumption that there is no working capital investment. So if we apply net present value decision rule, what we're going to do is to calculate the present value of the project cash flows, including the terminal cash flows, and subtract the investment amount or investment commitment or initial investment to figure out if the project has added any value, okay?
Yeah.
So this is a decision rule, and these are the variables in here. K in here, I should have maybe written it differently, which actually in a different slide, I have a slightly different expression for this. K implies cost of capital or weighted average cost of capital of both the required rate of return by creditors and the equity holders. So this is essentially a discount factor that combines the required rate of return by equity investors and creditors. And the cash flows associated in here are actually cash flows to both creditors and equity holders, okay?
Okay.
Here is, I rewrote this to align this with the textbook discussion, okay? In the textbook, we have this definition of cash flow where we have revenues of the project, operating costs, minus depreciation. So the operating cost defined in here does not include depreciation, so depreciation is treated separately. So you subtract depreciation. If project involves any debt financing, we subtract in interest expenses, okay? So 1 minus tax, this is the tax rate. So this gives us actually equivalent to NOPAT or net operating profit after tax, okay?
Yeah.
With one important distinction though, normally NOPAT is the profit that is available to both creditors and equity holders. In this case, we are subtracting the interest expense that goes to creditors. So essentially, in this case, this net contribution is the contribution that belongs to the shareholders, not the creditors. Okay, so we take the creditors' share out in here. So then we add back depreciation because it's been already subtracted in here.
Yeah.
And then we add back what we allocated to the creditors to, again, calculate the cash flows to all shareholders. And then if there's any working capital requirement, we subtract that and the CapEx in here. Another version of this is right here at the bottom. In this case, we don't mess with the interest expense at all. We only subtract the depreciation, add back depreciation, subtract working capital requirement and CapEx. So this is the cash flow that belongs to all the capital providers. As you see in here, if you use this definition of the cash flow, the discount factor is the weighted average cost of capital. Okay?
Yeah.
So provided that NPV is positive, this means that the capital providers to the firm generate a net value or create value for themselves. So essentially, fund providers of the project create value as a result of this investment if NPV is larger than zero. Obviously, if it is smaller than zero, then there is a value destruction, and project should not be undertaken and should be abandoned. Now, the approach that is used in the textbook is a little bit different than this approach that I presented in here. The approach that is used is an adjusted present value approach. This adjusted present value approach breaks up the project cash flows into its components. This is actually very useful because when we break down the cash flows, we understand where the value is originating from in the project. Because if we use this version, in this version, it is things are a little bit hidden. It's not very visible. Where the value is coming is not clearly seen. It is always useful to bring as much clarity to the value proposition that the project has in the project evaluation. That way we understand what are the drivers of the value for the project. So adjusted present value approach in that sense is very useful because it tells us what is really contributing to the value. For instance, in this first component, we just account for the contribution margin, meaning that the net contribution of the project this is only the impact of the net contribution. Then we do have the second component where we have a value associated with the depreciation tax shield that the project creates. And since we are making a fixed investment, we allocate depreciation. Our depreciation allocations actually save us taxes. In this second part, we capture or we show how much value is created through depreciation tax shield. And then the third piece in here, if we are using any financing, that is, if there is any financial costs are involved, then there is interest tax shield, and we try to see what is the financial impact or the financial dimension contribution to the project value. So this component shows us how much the interest tax shield is actually contributing to the value. And then finally, this last piece in here is the contribution of the terminal value. So that way we have a sort of a more granular perspective on the project, where we can understand what are the really value drivers. For instance, if this component is really small or even negative, but depreciation tax shield and interest tax shield is actually turning this into positive, then we might really need to look at the project characteristics, because the project itself, that this contribution of the project, contribution margin of the project itself should be quite significant or solid in order to feel comfortable about the project. So that actually gives us maybe a perspective to look at the project a little bit more carefully and to see if there's any way to control the cost, or maybe ways to push the project revenues up so that we can actually improve the contribution margin.
Okay.
Finally, in a lot of project evaluations, terminal value is very critical. That is, this is most of the time is the factor that makes or breaks a project. So we have to be very careful not to be too dependent on the terminal value, because terminal value is inherently difficult to evaluate. So, I mean, with precision. So there's a lot of uncertainty about this. You don't want your project's viability to entirely depend on the terminal value. Now, another issue that I would like to point out in here, we have the contribution margin without the impact. You have a question?
No, go ahead.
This component is purely equity perspective, meaning that this is essentially purely operational contribution of the project, and therefore actually we discount this at what we call unlevered cost of equity. So this is the cost of equity with the assumption that there is no leverage in the firm. Okay.
Yeah.
Similarly, we discount the terminal value with the same assumption, assuming that there is no leverage in the capital structure. We capture the impact of leverage right in here by capturing the present value of the interest tax share. Okay. Yeah. Now, if you noticed, I used discount factors that are different than these two, right?
Yeah.
Because this is the cost of unlevered equity. These are cost of debt, because the benefit that we generate, particularly in this case, that is interest tax shield, is actually dependent on the debt.
Yep, yep.
Okay. So therefore, we discount this at the cost of debt. This component, since the depreciation allocation is quite stable, as long as the company is intact, that is, as long as it does not default, we actually have a steady stream of cash flows because of the depreciation tax share. Okay? Yeah. That's why we would treat this as safe as the debt, and we will discount these cash flows at the cost of that, because this is not as risky as these cash flows. Okay?
Yeah.
So therefore, we discount these at the cost of that. So in the adjusted present value model, or the approach, is to decompose the project into its value contributors, as we did in this case, and we discount each of these contributors at the appropriate discount rate. In some cases, that is the unlevered cost of equity. In other cases, it is the cost of debt. Okay?
Yeah.
Now, with this, I just wanted to go to the example, okay? So we're going to look at the example and apply this framework. But we're going to do it obviously in an international context, so there's a lot more complication, and we will capture all of those complications in that context, okay?
All right.
Now, I just want to do something that will be useful for you. Do you see a chat box there?
A chat what?
A chat, chat.
No, I don't see a chat.
No, okay. What do you see on your screen?
I see the cash flow assuming no change in.
No. I'm talking about the Zoom menu. What do you have? You have a microphone sign. You have a video.
Yeah,
sign.
I have mute, I have stop video.
Okay, what else do you have there?
I have invite participant, share screen, chat, and record.
Click on the chat.
Yeah.
Okay.
Yeah.
Okay, I'm going to send you something. Okay.
Okay.
So I'm sharing a spreadsheet. Do you see it?
Yeah, I see it. Let me download it.
Can you download that?
Yeah.
Were you able to download it?
It's coming in like with so many files. I don't know.
It should be one file, multiple worksheets.
Yeah, I see a lot of files, yellow folders.
What files do you have?
I have default apps, extension, installer, what have you.
What?
Visual elements, Swift is not coming as expected.
The file that you have is called Centralia, right?
Yeah, that's the name. But then okay, let me see something.
I think you're seeing some other thing. You just need to download this one.
Yeah, that's what I'm doing. Let me see central.
Actually, if you double click on it, it should open it up.
Oh, okay.
Did it open it?
Okay, is that?
I can email you if you want this. We could do email too.
It's not coming. The one I downloaded, it came as a blank blank stuff. Yeah, I think you need to email that to me though. Or you recently let me see something because I downloaded it, but it came as a blank.
Okay, just a second. I will stop sharing right now. Okay.
Yeah. Or you could send it in my email box. Let me download it from my email.
Just a second.
Okay.
Okay, I emailed it to you. Check it out. When you receive it, you can open that.
Okay, then come on. Few minutes.
So I'm going to share the Excel sheet right now. Do you see? Can you see an Excel sheet?
Yeah, you have sent it. Let me download it first. I'm not I'm not seeing any of that. Okay, okay, I see it now. Okay.
Do you see the
Yeah,
Excel sheet in the screen?
yeah, I see it. I'm downloading it.
Well, you can take a look at that later on, but I just want you to walk you through this, okay? Did you get a chance to review that example that I told you, the Centralia example?
Yeah, I downloaded it. Hello, are you getting me?
I'm here. Are you there?
Yeah, I've downloaded it.
Okay, if you downloaded it, put it aside. Right now, you don't need it. I will. I'll tell you when you need it. Okay.
All right.
Are you ready?
Yeah,
Okay. So I ask you a question. Did you read the Centralia example in the book?
yeah, I did.
Okay. So here I have some of the basic assumptions associated with that case. Okay.
Yeah,
You remember there is a U.S. company who is considering an investment in Spain.
yeah,
The company has already a distribution center in Madrid, but they would like to make a sizable investment in Zaragoza. Okay.
yeah,
So the projected investment is about 5.5 million euros.
yeah.
At the current exchange rate of 132, this
Yeah,
is actually equal to US dollars $7,260,000. Okay.
that's right.
Currently, the company actually exports 9,600 units of its product to its distribution center in Madrid.
Yeah.
Okay?
Yeah.
And the projected growth associated with this sale is 5%.
Yeah.
And the contribution margin associated with this distribution center's activity is about $35 per unit. Okay. Now the company is planning to make an investment that is going to generate sales of about 25,000 units.
Yeah.
And each unit is going to create a 40 euro contribution margin. Okay?
Yeah.
Some other pieces of information in here, the expected inflation in US is 3%. Expected inflation in euro area is 2.10%.
Yeah.
Okay? Now, once the company makes the investment in Zaragoza, the sales are going to grow at a 12% rate per year, okay?
Yeah.
Now, the company normally funds its projects by using a 40% debt ratio, okay? 40% debt, 60% equity.
Yeah.
So if they make a, let's say, $7,260,000 investment, okay? So this is the amount of investment that they're going to make, right?
Yeah.
Normally, they would fund about 2.9 million, 40% of this with debt.
Yeah.
Okay?
Yeah.
So the Spanish government, in order to attract investment in the region that they are trying to attract foreign investors, offering a 4 million euro subsidized loan at a cost of 5%. Okay? So this is the cost of the subsidized loan, which is 5%. Normally, the Centralia would be able to borrow at 8%. Okay? So this subsidized loan actually has a value for the company. Okay?
Yeah.
So, and there is another piece of information. The Spanish government provides the company an opportunity to pay only 20% tax. So it is a subsidy, tax subsidy that they're offering. The US tax rate is 35%. But Spanish government also says that if you transfer any of your profits, your tax rate will be 35%. If you reinvest your profits, we are going to tax you at 20%. But if you repatriate your profits, you will have to pay 35%.
Okay.
Okay.
Yeah.
The company has 750,000 euros available in their Madrid distribution center. Okay.
Yeah.
So normally they would transfer this amount back home, but if the company makes this investment, actually they are not going to transfer this amount. Okay.
Yeah.
Okay. So these are our basic assumptions. With this, we are going to go and check out the operational cash flows associated with this project. Okay?
Yeah.
First step. So the exchange rate right now is at 1.32. Okay?
Yeah.
So what do we need to do for the exchange rate in year 1, year 2, year 3, because our revenues are going to be essentially in euros.
Yeah.
Okay, so we need to convert them into US dollars. Therefore, we need an exchange rate forecast.
Yeah. So we're using the relative purchasing parity using
Purchasing power, exact relative version of purchasing power parity. You see here.
So in year 1,
I use the spot rate of 132.
yeah.
And then 1 plus US interest rate divided by 1 plus
interest, the foreign rate.
In euro, exactly. That's true.
Yeah.
So if I do this, actually, as you see, I have the projected exchange rates in here.
So all to the various power, in year 2 to the power 2, year 3 to the power 3.
Exactly. You see here, what I did is that I took the assumption from the assumption tab, which I have the US interest rate, US inflation rate, I'm sorry.
Yeah.
And then this is the European inflation rate.
Yeah. What I did the spot rate multiplied by the 1 into bracket 1 plus the inflation rate of the US, or the 1 plus inflation rate of the euro for the first year. The second year, I raised both to the power 2, the third year to the power 3, the fourth year to the power 4, in terms of finding the foreign rate for that year.
Yeah, let me see. I did something in here. I don't know. How did that?
It should be, that one should be 1.3316 year 1. Okay, it's correct. Yeah, 1.3316. Year 2 is 1.3434.
There's something. Let me see what is happening. Yeah. The rates are correct. Yeah. Okay, so these are the exchange rates based on purchasing power parity, right?
Yeah.
Okay. Let me do something in here. So the operating profits in here in euro terms are going to be these figures. So these are all in euros, okay?
Okay.
And then these are the euros, once they are multiplied with 1.3136, or the exchange rate, let's do that. we're going to get the dollar equivalent of those revenues. Okay?
Yeah.
So these are our dollar revenues, or the dollar contribution margin actually. Now this part is the contribution margin on the lost sales. Now remember, we used to export to Madrid 9,600 units, right?
Yeah.
If we establish this factory in Zaragoza, we will not export that amount anymore, okay?
Yeah.
Remember also that amount is going to grow at a rate of 5%. You see, these are the units. If we did not have this plant, we would have these units of exports from the American home base to Spain. Now, the contribution margin for these exports were $35 per unit, but they were expected to grow at the rate of inflation.
Yeah.
Okay. So I adjusted those. You see, all of those are adjusted for the inflation. Okay.
Yeah.
Now I calculate the amount of lost sales, meaning that if we didn't have this factory, I would be able to export this amount, but now I can't export it, so I consider that as a lost sale. Okay?
Oh.
So in some ways, it is an opportunity cost. Okay?
Yeah.
So if I establish the factory, this is the cash flow I'm going to generate. This is what I'm going to lose. So in net terms, this is what I'm going to be generating. Okay?
Yeah.
So we call this incremental operating cash flows. Okay?
Yeah.
So they are projected going forward. And then we calculate the after-tax version of this, assuming a tax rate of, let's see, on B18, we assumed a US tax rate of 35%. Okay?
Yeah.
So if you calculate the present value of these cash flows at cost of capital of 12%, which is actually a given information, this is the cost of the unlevered equity. Okay?
Yeah.
So if we discount these at this rate, we get 5,374,000 value. Okay? So this actually, what I showed you in here is equivalent to let me go to the adjusted present value. This first factor, okay?
Yeah.
This first factor is just the operational cash flows that we generate. Okay?
All right.
So now we are going to go and understand the contribution of the tax shield. Okay, remember, this is we are going to establish a factory. We will have equipment, and this investment is going to be depreciated on a straight line basis over an 8-year period. You see, this is the annual depreciation expenses. Okay.
Yeah.
I convert these at the projected exchange rates into US dollars. Okay.
Yeah.
And then calculate the depreciation tax shield again with the 35% tax rate.
Yeah.
US tax rate. I calculate the annual depreciation tax shield. And then I calculate the present value of these depreciation tax shields. Okay?
Yeah.
So what I have in here is the present value depreciation tax shield. Okay?
Yeah.
So with this, we captured this part, okay?
Yeah.
This is the second part. This is the impact of the depreciation, okay?
Yeah.
Now, we are going to now evaluate something that actually did not show up in our first discussion about the adjusted present value. So this is the value of the concessionary loan, meaning that if the company is able to use a subsidized credit, we need to understand what is the contribution of that subsidized credit to the value of the project, okay?
Yeah.
In the international version of the adjusted present value, we have actually that contribution calculated in here. I have right in here in this actually some of the arrows just shifted. The value of the concessionary loan is right in here. So this is the depreciation tax shield. I need to change. So this is the depreciation tax shield we already calculated. Okay.
Yeah.
Here's the interest tax shield. We will get to that in a little bit. Okay. Oops. This is the present value of the terminal value. We'll get to that later as well. But the part that I actually want to talk about is this part. Okay, this is actually the value of the concessionary loan. So this is the face value of the loan, which is 4 million euros. Okay.
Yeah.
This is the present value of the loan cash flows at the subsidized cost of debt. So here we are. So we are going to receive a 4 million euro loan. Okay.
Yeah.
We're going to make payments 500,000 euros each year over an 8-year period. This is an 8-year loan. Principal is 4 million. We are going to pay it in equal installments of 500,000 over an 8-year period. Okay.
Yeah.
Now, the cost of the loan is 5%. So first year, before we make any payment, our interest cost is going to be $200,000 because outstanding balance is 4 million. Okay.
Yeah.
Interest is 5% interest is going to be charged on 4 million. So our interest cost is 200,000. Okay.
Yeah.
So this is euro. All right.
Yeah.
This is another euro payment. So our total payment in euros, 500,000 plus 200,000 interest, 500,000 principal plus 200,000 interest, 700,000 euros, right?
Yeah. No, go over that again. Yeah.
You know what? Let me create one more column in here. So loan payments in euro. So our payments are going to be 500,000 plus 200,000. Okay.
Yeah.
So these are our annual payments, including principal and interest. Okay.
Yeah.
This is the dollar equivalent. So I take the 700, multiply with 1.3316, I get this, okay?
Yeah.
Now, this is the stream of cash flows. I calculate the present value of these at the market rate of 8%.
Before you go to that, in the second year, the interest payment 175 is the same 5% multiplied by what?
In this case, 5% is multiplied with 3.5 million.
Oh, okay, because the first year, or the 5% times the 4 million, right?
Yes, because we paid 500,000 principal. Now our loan balance is 3.5 million.
Oh, okay.
Next year it's going to be 3 million, right?
Yeah.
So our interest charge is going to be 5% of 3 million.
Okay. All right.
And then here 5% of 2.5 million, and so on. Okay.
Okay.
All right.
Yeah.
So these are the dollar values of the interest payments. Okay.
Yeah.
Now, at the market rate, which actually, if we go back to here, market cost of interest is 8%, right?
Yeah.
So if you calculate the present value at the market rate, it is 4,887,311, right?
Yeah.
Now, this is the value of the concessionary loan. 4 million times at that time, at the time of borrowing, it was 132 exchange rate, right?
Yeah.
So the dollar value of the loan is 5,280,000. Okay.
Mm-hmm.
So we actually paid 4,887,311 for something that is actually worth $5,280,000. Okay.
Yeah.
So this gives us an advantage of 392,689. So this is actually a value that we captured because we used the subsidized loan. Okay.
All right.
So essentially, what we did in here, we calculated the loan payments. Okay.
Yeah.
Calculated the market value of these payments, which is 4,887,000. And then we calculated the face value of the loan at the spot exchange rate, which is 5,280,000. The difference is our benefit. Okay?
Yeah.
So that's why we call this the benefit of concessionary loan, or value of the concessionary loan. So it is 392,689. So if you go back to here, this component actually is the value of the concessionary loan. So this is S0 times CL0. CL0 is the concessionary loan, which is 4 million euros, right?
Mm-hmm.
We converted at 1.32 into dollars. And then we subtracted the present value of all the loan payments at the cost of debt, actual cost of debt, okay? So that difference is our benefit, or the value of the subsidized loan. Okay?
Yeah.
Okay. So now we have that piece, and then now we are going to calculate the present value of the interest action. So how much this use of loan is going to contribute to the value of the project, okay? So here, these are the interest payments that we are going to make in euros, okay?
Yeah.
We are going to convert these into interest tax shield in euros. So this is actually this column. This column has the interest tax shield in euro terms, okay?
Mm-hmm.
And we convert this into into US dollar in here, but there is a little bit of a trick in here that I want to explain. You see this box in here? That's where I'm explaining. So here you see something called projected debt ratio. Okay.
Yeah.
How did I come up with this one? The company's optimal debt to value ratio is 40% or 0.4.
Yeah.
Okay. That means that if actually company was financing its project at the optimal debt ratio, 2,904,000 of the $7,262,000 of the project cost had to be debt financed.
Yeah.
But the company actually used 4 million euros debt, right?
Yeah.
4 million euros at the market rate was equivalent to 5,280,000, right?
Yeah.
So actually twice as much what really company's optimal capital structure is telling. Okay.
Yeah.
So we will assume that the company actually, although it is using this amount of debt to finance this project, will have to scale back its leverage by maybe issuing more equity. So what we need to do is not to account for all the tax shield that this project is creating, because it is using a lot more than that it's supposed to use. Okay.
Mhm.
So the actual debt ratio, if you use the 4 million out of $5.5 million of project cost, the debt ratio is actually 73%, right?
Yeah.
But optimal debt ratio is actually 0.4. So we need to account for only 0.4 divided by 0.73 or 0.55% of the calculated interest tax shield. Okay.
Yeah.
So what I'm going to do, I'm going to use this to scale back the interest tax shield. So normally, actually, interest tax shield, for instance, for $200,000 payment at the 35% tax, it's $70,000, right?
Yeah.
But when we make this adjustment, so $70,000 times 0.55 is 38,500 euros. I'm sorry, these are in euros. So you see, I adjusted to 38,500 and then converted into dollars by using this projected rate. Okay.
For the purpose of understanding, at least you can put a
Oops.
purpose of studies or more understanding.
Samuel,